Economic performance is expected to have remained steady in the first quarter, boosted by relaxed lockdown restrictions. SABC will release the first quarter gross domestic product data tomorrow. Economists expect a 1.2% growth, steady from the 1.2% growth that we saw in the fourth quarter of last year. The local economy continues to face challenges such as power constraints and other structural weaknesses that are hindering growth. Other so-called headwinds include rising inflation resulting from the increased cost of food and fuel, curtailing the spending power of consumers. Supply chain disruptions and the Chinese lockdown restrictions also pose a risk. It's expected that the primary sectors were under pressure in the first quarter, with agriculture battling foot and mouth disease and heavy rainfalls. Economists say despite supportive commodity prices, mining output is expected to have declined in the first quarter, especially in the platinum group metals and gold production. All right, it's time for your Monday markets, and we'll look at that slew of economic data shortly. But firstly, our special weekly feature focusing on the markets and the economy. And the number that we're focusing on today is the price of oil. Of course, this is a number that affects everyone who moves around in South Africa because it will affect the future price of petrol. Oil topped $120 per barrel today. The main driver is Saudi Arabia, which is the de facto leader of the oil cartel OPEC. It raised its prices for July, which is seen as a barometer of how tight supply is due to the war in Ukraine. So, ouch, $120 again. We've been higher before, but then we came down. This level again does not bode well for our petrol price change in July. Now, despite the soaring oil price, the markets have been trading higher today. Investors are focusing on the outlook regarding interest rates, and some see it as an opportunity to buy stocks after several very rough weeks. The reopening of Beijing after heavy COVID-19 restrictions there has also boosted investor confidence. Let's take a look at how the local market fared. Right, so all up. Let's look at the economic week ahead now. There's a slew of economic data being released. The most important is GDP, which will show how much the economy grew in the first quarter. As we said, many economists are expecting around 1.2% growth, which is in line with what we saw towards the end of last year. We're joined every Monday by our economics editor, Tshepo Mongoai. Great to have you with us, as always. GDP is basically the output of the economy, the size of the economy. Why do we track it? Why is it so important?
It is quite important because it measures the strength and the resilience of the economy as compared to other countries. Investors look at it to see the level of activity that are taking place in the economy. So it is a very good indication of the level of activities across sector, and then you're able to make decisions based on that particular number, especially for investors, for government, and also you get a sense of what to expect in terms of revenue collection, because the more we have activity in the economy, obviously that translates into more government revenue. So it is quite important. And
more growth equals more jobs, presumably.
Absolutely, it depends who you talk to. I mean, if you speak to most mainstream economists, they will tell you that for every 1% in growth, you have zero, I think it's 0.9% in job creation. But it's not a straightforward answer, although, I mean, many people make it to be that way. You have instances where we often talk about jobless growth, and we know, you and I, most boards, when they sit around the table, their priority is creating shareholder value. And if they have to employ the choice to use a machinery or employ 10 people, they would obviously go for the machinery. And this is where most industries are. If you look at many manufacturing plants, they've mechanized because they know by so doing, especially in our context, and they've said this repeatedly, it's fewer trips to the CCMA, and obviously they spend less time sitting around the table with the labor unions, having sleepless nights. Because machineries will not do that. So it is.
Well, not yet. Maybe one day they will. But okay, so technology plays a role. But surely if we have a stagnant economy, then jobs won't grow. Would you say 1.2% again, some even saying 1.7%, but it's nowhere near where we want to be?
No, absolutely.
Is that stagnant to you?
Absolutely. Our level of economic growth at around 1%, 1.7%, it's not able to address, I'm talking social issues. I mean, even people who are currently in the employment, there are a lot of immediate threats to their jobs that can emanate because of low economic growth. So there is a lack of security in terms of employment. When you have such low level of activity, the issue of labor becomes a problem, because the increases in salaries are very minimal, because obviously for most employers, they have to prioritize their shareholders, and obviously for them that's quite important. So they're not able to get those increases. So the tensions, as you can see now, they are reaching boiling point. Although, I mean, fortunately, we've seen some being addressed. But you can tell that there are some pressure emanating from very low economic growth. So we do need economic growth. There's no question about it. There are more benefits of having higher economic growth, and I mean, already in terms of South Africa, the scenario that has been pitched is that we need at least 6% economic growth. And we're very far from that. We're not anywhere close to that. But the question remains, are companies and employers willing to put resources towards poverty and job creation? I mean, if you look at the amount of money spent on the issues of environment, it's huge.
Yeah.
I'm not saying the issue of environment is not important, but issue of jobs and the issue of poverty are as important as the issue of environment. You saw what's happening in KZN. So that's
huge,
important.
Yeah. Look at the difference. 6% is where you say we need to be. FNB and Investec predicting 1.1% for this entire year, just showing that huge gap. Very quickly, mining data out, also business confidence. What are you expecting?
In terms of mining data, obviously that has been the mainstay for the past year or so. We still expect some good activity coming from the mining sector, thanks to very good commodity prices, business confidence. We've emerged from some of the challenges we've seen in KZN and floods. We expect some stability, although there is still high prices that many businesses are dealing with. But in terms of the business environment, there is a kind of stability in terms of what to expect. So that is going to assist in terms of boosting business confidence.
All right, so it's not all bad news. We'll bring you all that data. Thank you very much. That was our Monday Markets and our weekly meetup with Tshepo Mongoai, SABC News' economics editor.